So, have you ever wondered whether companies that dodge taxes actually end up more valuable, or if that's just a myth? Because there's this new study on Indonesian mining firms that might surprise you.
Oh, I know the one you're talking about. What caught my eye is how they dig into tax evasion, not just legal tax avoidance, but the whole spectrum, including the gray areas companies dance around to pay less tax.
Exactly. And the twist? The researchers found that, for these mining companies, tax evasion doesn't really move the needle on firm value in a significant way. I kind of expected a stronger link, you know?
I did too. Especially since, in other countries, dodging taxes can either boost or hurt a company's value depending on the market's reaction. But in this study, the numbers say otherwise, except in one specific case, where profitability seemed to play a moderating role.
Right, and before we unpack that, I think it's worth highlighting how they measured all this. They used the effective tax rate as a proxy for tax evasion, but also looked at things like family management, who owns the company, and leverage. All those factors play a part in how a company operates. You know, what I found particularly interesting is the impact of family management. Turns out, having a company run by family members actually led to lower firm value in most cases.
That stood out for me too. It sounds counterintuitive at first. But in the Indonesian mining sector, maybe families are more risk-averse or worry more about reputation, so they're less aggressive with tax maneuvers, which the market doesn't necessarily reward.
Makes sense. And ownership concentration? The study suggests when a few major shareholders hold most of the shares, firm value actually goes up. Maybe the big players are more hands-on with monitoring and making sure the company stays out of trouble.
Yeah, it probably helps keep managers in check. But I also noticed, even with these governance aspects, family management, ownership concentration, they didn't moderate the relationship between tax evasion and firm value. It's almost like those effects stay in their own lanes.
That actually reminds me profitability, company size, and leverage were also tested as moderators. But none of them really changed the basic relationship either. Let's talk about those firm characteristics. The common wisdom is that bigger or more profitable companies should have more muscle to play with their taxes, right? But this research didn't show any significant effect on firm value.
True, and it surprised me. Leverage so, how much a company relies on debt was the one factor that consistently showed a positive effect on firm value, except in one model. It seems using debt strategically can boost a company's appeal, at least in the eyes of investors.
But at the end of the day, even those factors didn't change how tax evasion and firm value interact. The study basically says, no matter how you slice it, family-run, tightly owned, big or small tax evasion just isn't a game changer for firm value in Indonesian mining.
I've had something like that happen too, where what seems like a big deal like tax strategy turns out not to matter as much as you'd expect, at least in certain contexts. It really underscores how business, culture, and market norms shape what pays off and what doesn't.
So, if policymakers are hoping to link anti-evasion efforts to boosting firm value, this study throws a wrench in that plan, at least for Indonesian mining companies. Maybe the real levers are elsewhere.
Totally. And it leaves room for more research too. For instance, what about other sectors? Or what might happen if you study these trends over a longer time, or even before and after COVID? There's a lot still to dig into.
Yeah, and maybe looking at even more nuanced forms of governance or splitting out different periods could reveal patterns that just don't show up here. It's a good reminder that one size rarely fits all when it comes to tax and business value.
Absolutely. If nothing else, it's proof that we can't just copy findings from one context to another and expect them to hold. Business and tax strategy especially tends to be a little more complicated than that,